Alright, hi guys, welcome to this first swing trading system that I'm going to teach you, and it's known as the Bollinger Mean Reversion, or the BMR. This is a core trading system that I use personally, and I've got fantastic results from this. So first, let me define the methodology behind the system. The BMR is a swing trading strategy that seeks to buy stocks that are oversold on a short-term basis, and to short stocks that are overbought on a short-term basis. So in other words, this is a counter-trend mean reversion strategy. We're going to buy right at the bottom of a downtrend to catch the reversion to the mean. And we're going to short right at the top of the uptrend when it's really overbought to catch the reversion back to the moving average. The average expectancy per trade for this strategy is 0.5 R to 1.2 R per trade. The average win rate goes from anywhere from 50% to 80% depending on the period or the month. The average R win is 2R and the average R loss is -1R. So let's take a look first of all at the long setup. We look for a specific candlestick pattern when we go long on the BMR, and that is known as a bullish pin bar. We've covered this on the lesson on candlestick patterns, but here's a quick revision. What's a bullish pin bar? A bullish pin bar is a specific candlestick pattern when the candle body is relatively small. Right? In this case, you see over here, small candlestick body, a small body, and in these cases, these are what we call dojis. But dojis have got no candle body. The open and the close are the same price. So you've got one line to signify the candle body. And so the first thing is it's going to have a small candle body or no candle body, and there must be little or no upper shadow. Okay, little or no upper shadow. You either have a small upper shadow or none at all. Okay, but the most important thing is that you need to have a long lower shadow, like so. And the lower shadow has to be specifically at least 2/3 the range of the entire candle. Right, so recall that the range is the top of the candle all the way to the bottom. That's the entire range, from here to here. So we want to ensure that for bullish pin, the lower shadow has got to be 2/3 of the length of the entire candle. And that is what a bullish pin is. So these are 4 variations of the bullish pin again, right? You can look like this, like this, like this, or like this. They all have that same characteristic. Next, when we go long on the BMR setup, we always need to have a bullish divergence reversal pattern. So again, do revise the chapter on divergence reversal patterns under technical analysis, and I'm going to review it very quickly over here. So remember that for bullish divergence, we always connect and compare swing lows, okay, on both the price chart and the indicator chart. So in this case, you can see that this is a swing low, that's a swing low, and that's a swing low. Okay, bullish divergence reversal can only appear at the bottom of a downtrend or at a swing low. Okay, so what we do is we connect the swing lows. For example, you can connect this swing low to this swing low, this swing low to this swing low. Now, obviously, right now, after we've had a sell-off in the stock, we are right at the bottom of the downtrend at this point of time. So this is the current swing low. So we're going to connect the current swing low to one of the previous swing lows, right? So for example, we could connect this low to this low, forming this line over here, right? And then what we do is we then look at one of the indicators. For the BMR, we will look at the MACD, the full stochastics, and the relative strength index. You can also use the CCI, which is the commodity channel index if you so wish. Okay. Now, what we want to see is we want to see the price trend making a lower low, like in this case. But we want to see at least one of the indicators showing a divergence. In other words, the indicator is making a higher low, going against the price low. So in this case, the price is making a lower low, but the relative strength index, as you can see, the corresponding low over here, connect this low to this low, what do you get? That's right, you get a higher low. So price is making a lower low, RSI is making a higher low. That's a divergence pattern. So you need to see at least one divergence on at least one of the indicators, either the MACD, the full stochastics, or the RSI. In this case, it appears on the RSI. It also appears on the MACD. In fact, if you connect this swing low over here to this, sorry, it should be a straight line, and you take the corresponding swing low on the MACD, you can see that, again, this is sloping down, that's sloping up. So you've got a double bullish divergence. Okay, so we need to have at least one divergence. I repeat again, one divergence. For this strategy, this is how we set up the chart specifically. And these are the indicators we're going to use. First, we're going to put in the Bollinger Bands. Okay, standard default setting, 20 SMA, 2 standard deviations. We're also going to use the 50 moving average, which is the blue line you see over here, and the 20 exponential moving average, which is the red dotted line. We're also going to place 3 indicators, which is the MACD 12.26.9, the full stochastics 533 setting, and the relative strength index setting of 10. So this is a specific chart setup we're going to use. I'll demonstrate it on the TC2000 software in the later part of this lesson. Now let's take a look at specific entry rules when we go long for the BMR. So now let's take a look at specific entry rules when going long for the BMR setup. These are the specific entry rules that have to be followed precisely. The first thing is look at the S&P 500 or the SPY. Okay, so the first condition is that the SPY or the S&P 500 has to be above the 20 exponential moving average. This tells us that the overall market is bullish. Remember, it's only when the market is very bullish do we take a long swing trade. Okay? Not only that, we want the S&P 500 MACD to be bullish as well. So that's the first condition. The second condition is looking at that stock itself. We want the price to decline rapidly to a new low, and it should be the lowest low of the last 6 months. The highest probability is when this coincides with a previous level of support, when the bullish pin bar goes below the previous support level and takes out the previous lows. Okay. Next condition, we must have a bullish pin that pierces or appears outside the lower Bollinger Band, and it should appear far away enough from the 20 exponential moving average that could act as a resistance when the price goes up. Next, we need at least one bullish divergence reversal to appear on the MACD, stochastics, or relative strength index. Alright, so 4 specific entry rules that must be met when you go long on the BMR setup. So let's take a look at the chart below and see if it meets all the criteria. Okay, so of course the first thing is to look at the S&P 500. It must be above the 20 EMA. The MACD has to be bullish. Alright, now on this particular stock we're looking at Electronic Arts or EA. Let's take a look, does it meet the criteria? What's the first criteria? Price has to decline to a new low. So you can see the price is on a downtrend, like so. It's on a downtrend. Okay, and it's right now declined to a new low. This has got to be the lowest low over the last 6 months. Okay, so this is the lowest low. Next, we want a bullish pin bar to pierce the lower Bollinger Band or to appear outside the lower Bollinger Band. So in this case, we have got a bullish pin bar that pierces the lower Bollinger Bands. Okay, so there we are. It must be far away enough from the 20 exponential moving average. So notice that this is the 20 EMA and that's the 50 moving average. So we want the price to be far enough from the 20 EMA and the 50 MA. Why? Remember that when the price is too far away from the moving averages, it's oversold. It tends to snap back to the moving average. So you want it to be overstretched to have that snapback pattern, so you would long as it snaps back. That's the first reason. The second reason is because remember that moving averages act as a resistance on a downtrend. And in this case, we are taking a counter trend trade. We are buying at the bottom of the downtrend. So once we buy, we want to hit our target price before having a chance to hit one of the main moving averages. Okay? Now you may say, how far must it be from the 20 EMA? Well, the rule of thumb is that you want to ensure that when you enter the trade, you must get at least 1 hour in profit before hitting the 20 EMA, and at least 2 hours in profit and hit your target price before hitting the 50 moving average. That's a rule of thumb. Okay? Next, we want to see at least one bullish divergence appearing on the indicators. So in this case, let's take a look. Do we have a bullish divergence? Yes, we do. Because if we connect this swing low over here to this swing low over here, let me draw a line as straight as I can. Okay, I don't have a ruler, but I'm going to draw it as straight as I can. Okay, that's the best I can do. All right. So the price is making lower lows, and if you look at the corresponding indicator on the MACD, what's happening? That's right. The MACD is making higher lows. So we have a bullish divergence. So that meets all the criteria for this long setup for BMR. So how do we place our orders? Where do we enter? Where do we exit? Okay. So take a look at this chart over here. Again, you can see that the price of Adobe has declined to a new low. Okay, we have a bullish pin bar that appears outside the lower Bollinger Bands. Okay, and assuming that we have a bullish divergence as well. Okay, we're going to go long and we're going to buy and we're going to take a quick profit as it reverts back to the mean. So specifically, where do we place our entry points? Let's take a look. Okay, number one, our entry. We will place a buy stop limit order 1 to 10 cents above the bullish pin bar. So let me zoom in. Can you see this bullish pin bar? Okay, great. We're going to put a buy order 1 to 10 cents above the high of this bullish pin bar. Okay, now you may say, hey, 1 to 10 cents is a big range. Do I take 1 cent or do I take 10 cents? Well, here's a rule of thumb. It depends on the price of the stock. Okay? In general, if your stock is less than $5, you can take a 1 cent approach. Okay, so in other words, you place the buy order, the buy stop order, 1 cent above the high of this candle. 1 cent above the high. All right. Now, if it's a $5 to a $10 stock, you could use 2 cents. Again, this is a rule of thumb which I use, right? If it's $10 to about, say, $50, you can use a 3 cents entry, all right? Where the buy order is 3 cents above the high of the bullish pin bar, right? And if it's $50 to $100, you can use 5 cents. Anything above $100 stock, I would use 10 cents. Okay? So this is the rule of thumb of where we place our entry order. Okay? Great. So once again, we place our buy stop order, which is the entry, 1 cent to 10 cents above the high of the bullish pin bar. We place our stop loss order, which is a sell stop order, the same number of cents below the low of the bullish pin bar. So we are buying over here. That's our stop loss. So the distance between the entry price to the stop loss price is again our risk per share, also known as the 1 hour distance. Okay. Next, we place a profit target, which is a sell limit order 2R above the entry price. For example, if 1R happens to be $1, 2R will be $2, as you have learned in the lesson on position sizing. Okay, so we have got a sell limit order, our buy stop limit order, and our sell stop order. What's really important to note is that ensure that there's at least a 1 hour distance to the 20 EMA. Okay, so in other words, this is 1 hour, as you can see over here, and we have to ensure that we can hit, or rather the price can move at least 1 hour in our favor before hitting the 20 EMA. Why? Because once the price moves 1 hour in our favor, we can shift our stop loss to the entry price. So we have a risk-free trade. So the worst that can happen is the price hits the 20 EMA, comes down, hits our stop loss, we don't lose anything, right? We've got a 0R break-even trade, okay? And we have to ensure that the stock can reach 2R in profit before hitting the 50 moving average. Because the 50 moving average is a very strong resistance. So we have to take our profit before hitting the 50 moving average. Now, once you're in the trade, what do you do? Like I mentioned, we shift the stop loss to our entry price once the price moves 1 hour in our favor. Okay? Subsequently, we allow the price to hit the stop loss or the profit target. So in other words, what's the outcome of this trade? We either get a 2-hour win, a minus 1 hour loss, or a break-even 0-hour break-even trade. Alright, so let's take a look at some examples of long BMR trades that I've been taking. This is an example of DLR, Digital Reality Trust. So let's look at the setup. You can see it's a very clear downtrend, okay, that's been oversold, right? And again, at this point, we're right at the bottom of the downtrend, and we have a bullish pin bar that appears, and it pierces the lower Bollinger Bands, okay? So what do? We check for divergence, and you can see that there's a divergence that appears on the MACD, where again the price makes lower lows, right? You connect this swing low to this swing low, and the MACD makes higher lows. Okay, so you've got one bullish divergence pattern that appears at the bullish pin bar. Okay, so there's a very high probability of a reversal, and we place our order. Again, this is a $90 stock, so we'll place our buy order about 5 cents above the high of this bullish pin bar. Okay, so we'll place a buy order again. So the stop price would be 5 cents above the high of this candle, and the limit price would be another 5 cents above the stop price. Okay, so what does this mean? This means that the next day, if the price goes 5 cents above this pin bar, it would stop and buy at the market price. But we have to set a limit because we do not want to buy if it gets too high by gapping up. So we place a limit price 5 cents above the stop price. Remember, the stop price is the entry price that we intend, but the limit price is the maximum we would go. All right, so I repeat that again. The stop price would be 5 cents above the high of the candle, and the limit price would be 5 cents above the stop price. Okay, we will place our sell stop order 5 cents below the low of this candle, and again the distance between the entry and the stop loss is 1 hour. 1 hour. Okay, so you have to ensure that you can reach 1 hour without hitting the 20 EMA. which we can quite easily. So in other words, the price is far away enough from the 20 EMA, right, and it's oversold, that is ready to snap back up. Okay, and we must be able to reach our sell limit, which is 2R, before hitting the 50 moving average, which is the blue line. As you can see, the 50 moving average acts as a strong resistance. So we have to take our profit and get 2R before we hit the 50 moving average. So in this case, it's a very nice trade being set up. What happens the next day? The next day, you can see the price opens higher than 5 cents above our high. It gets triggered. 1, 2, 3 days, it hits our profit target. So in 3 days, we're out of this trade. We take our 2R profit. Let's take a look at another example. STLD. So once again, this stock, right, it went all the way to a new low. We have a bullish pin bar that appears outside the lower Bollinger Bands. Okay, check. We have a bullish divergence that appears on the stochastics, right? Price makes lower lows and the stochastics makes higher lows. So we've got one bullish divergence that we need. We place our buy order. In this case, it's a $23 stock. So we can place our buy order 3 cents above the high of this candle. So that is our stop price. And again, the limit price 3 cents above the stop price. Our sell stop order 3 cents below the low of this candle. That is our 1R distance. So once again, we must be able to hit 2R before hitting the 50 moving average that acts as a resistance, right? As you can see over there. So sure enough, we can hit 2R easily. So we place our profit target over there, our entries over there, our stop losses over here. Okay. So the next day, the price goes up, triggers our entry 1, 2, 3, 4, 5. 5 days, we hit our target profit. Swing trade is complete. Exit for profit. Here's another example. AWR. So once again, price declines rapidly to a new low. We have a bullish pin bar appearing at the lower Bollinger Bands. We have a bullish divergence appearing on stochastics. We're good to go, right? We place our buy order 3 cents above the high of this candle. Limit price 3 cents above that stop price. Stop loss 3 cents below this candle. So in this case, it's a very small candle. So our 1R distance is relatively small. Okay. And we can hit again 1R before hitting the 20 EMA and 2R before hitting the 50 moving average. So this is a very low risk trade. 1, 2. In fact, yeah, within 2 or 3 days, we've hit our target price and collected another 2R in profit. Let's take a look at this last example for long BMR using the Think or Swim charting software. This on Goldman Sachs. Okay, so once again, you can see the price declining to a new low. That's a new low. Bullish pin bar appears at the lower Bollinger Bands. We have a bullish divergence on MACD. Right, you can see price making lower lows, MACD making higher lows. We have a bullish divergence. Okay, beautiful. It's a $180 stock. So we'll place our buy order, okay, 10 cents above the high of this candle. So that is our entry price, which is the stop price, 10 cents above the high of this candle. We then place a limit price 10 cents above that stop price, right? We place our sell stop order 10 cents below the low of this candle. We have our 1 hour distance. Again, we set our 2 hour target to the, place a sell limit order over there. It's before the 50 moving average. Triggers the next day 1, 2, 3, 4, 5, 6. When does it hit? Let me see. 6, 7, 8, 9, 10, 11, 12. approximately about 12 or 13 days, just over a week, we hit our target profit. So that is the setup for the long BMR. Alright, moving on to the BMR short setup. So the reverse, we look at the bearish pin bar when we're going short. Okay, so the bearish pin bar is a bearish reversal pattern. So remember that it's a specific pattern where, once again, we have the body of the candle being really small, and there's little or no lower shadow in this case. Okay, and the upper shadow for a bearish pin bar must be long. Okay, it must be at least 2/3 the range of the candle. So again, this, and this, all four qualify as a bearish pin bar, right? They all have small candle bodies, as you can see. This is a doji where there's no candle body whatsoever. A very small lower shadow, or none at all, but very long upper shadow. Okay, if you recall from the video or the lesson on candlestick patterns, it indicates that bears have taken control of the market. All right, because after the bulls pushed the price up, the bears brought it down and closed the day bearish. Okay, so for bearish BMR, we're looking at the bearish pin bar. For the BMR short setup, we are looking at the bearish divergence reversal pattern. Okay, so remember that for bearish divergence, we connect swing highs. All right, we connect swing highs on the price, connect swing highs, and as the price makes higher highs, we want the indicator to make lower highs, right? So correspondingly, okay, the indicator, whether the MACD, the stochastics, or the RSI, must be making lower highs. Okay, so recall, when price makes higher highs, indicator makes lower highs, we've got a divergence, a conflict in the price, and there's a high chance we will get a reversal down. Okay, especially when we have a bearish pin bar. Alright, so let's look at the specific entry rules. First, before taking a BMR short setup, once again look at the S&P 500, the overall market, the SPY ETF, if you want to as well. So again, the S&P 500 or the SPY must be below the 20 exponential moving average. This tells us that the overall market is in a bearish mode. Okay, and the SPY MACD should be bearish as well. Okay, so that's the first condition. Next, looking at the specific stock, in this case we're looking at ARRS. We want to see, in this case, price rising rapidly to a new high, and it's going to be the highest high over the last 6 months. The highest probability is when this coincides with a previous resistance level as well, and we want the bearish pin bar to be higher than the previous highs on the resistance. So what do I mean by this? For example, if you see that this is a high, that's another high, that's another high, so this is a, sorry, let me just draw that again. Okay, this is a high, that's another high, that's another high. Okay, so imagine this is a resistance level, that's a resistance, right? Okay, so what we're going to see is the price is going up, okay, and having a bearish pin bar, like so. And we want this bearish pin to be higher than the previous highs of that resistance level. So this high takes out all these highs, and then we anticipate it to reverse back down. Okay, so once again, this bearish pin must appear outside or piercing the upper Bollinger bands. Okay, and it should be far away from the 20 EMA. When it's far away, it's overbought, it tends to snap back down. So we're going to short and catch the snapback. We want to see at least one bearish divergence on the indicators, either the MACD, the stochastics, or the RSI. So let's take a look at this example. You can see price is rising rapidly to a new high, and it's the highest high in the last 6 months. we have got a bearish pin bar appearing outside the upper Bollinger Bands. We have got a bearish divergence on the MACD and the stochastics, right? So perfect. We are looking for it to reverse down, right? So we're going to take a short entry over there, put a stop loss over there, and catch the wave down, take our profit somewhere over here. Okay, placing orders. Where do we place our entry order? So when we're going short, recall that our entry will be a sell stop limit order. All right, a sell stop limit order. Okay, so the moment it goes to a certain price, stop, sell it. Okay, but not too far down, so we have to place a limit. Okay, so again, where we put a stop order, 1 to 10 cents below the bearish pin bar, and the limit order again a few cents below the stop order. We place our stop loss, which is the now in this case the stop loss is a buy stop order, because if it goes up, right, and we're losing money, we're going to stop and buy it back straight away, right? So the buy stop order has to be again a few cents above the bearish pin bar. Okay, so let's take a look at this. So this is a $30 stock. We're going to use 3 cents, right? 3 cents. So we're going to place our sell stop limit order. Okay, we're going to stop and sell 3 cents below the low of this candle. Okay, 3 cents below the low of this candle, and we're going to place a limit 3 cents below that stop price. Okay, so this is our entry price. We're going to place our stop loss, which is our buy stop order, 3 cents above the high of this candle, right? So that is our 1 hour distance. So again, we have to ensure that it is far away from the 20 EMA. It can move by 1 hour before reaching the 20 EMA and hit 2 hours before hitting the 50 moving average, which you can see is a strong support. Okay, strong support over there. So we have to exit before we hit that support level. Okay, so we're going to place our target price, our TP, sell limit order. Okay, excuse me, this is a typo. This should be a buy limit order. Right. Okay, because when it hits our profit target, we're going to buy back and take our profit, right? So this is a buy limit order. Okay, 2 hours below the entry price. Okay, so what happens once we're in the trade? Okay, if the next day the price goes below our entry price, we get triggered, we're in the trade. So once we're in the trade, we can shift our stop loss to the entry price. Once the price moves 1 hour in our favor, we can shift our stop loss to the entry price with a break-even trade. Subsequently, we leave the trade to hit the profit target or hit the stop loss. So again, what are the 3 outcomes? We either get a 2 hour win, minus 1 hour loss, or a break-even trade. Right, time to look at a couple of examples. First, let's take a look at Visa. Here's a great short BMR setup. Again, look at the price rising rapidly to a new 6-month high. Again, the highest high in the last 6 months. Bearish pin bar appearing outside the Bollinger Bands. We have got a bearish divergence happening on the stochastics. As you can see, price making higher highs, connecting 2 swing highs, and on the indicator making lower highs. So we've got a bearish divergence. Very nice setup. Where do we put our entry? Right. Once again, our entry would be 5 cents below the low of this candle. So we put a sell stop order 5 cents below this candle, and the limit price 5 cents below that stop price. Okay. Our stop loss would be 5 cents above the high of this candle. This would be our 1 hour distance. Okay, and our target price would be a buy limit order, 2 hour below that. Excuse me. All right, so the next day, the trade doesn't get triggered, but we are still at the upper Bollinger Bands. The following day, the trade gets triggered. Okay, price goes up a bit and then boom, goes all the way down. Hits our target profit nicely. This on a CRUS. Once again, very nice setup. Price rising to a new high, overbought, overstretched, outside the upper Bollinger Bands. We have a bearish divergence on the MACD. Okay, price making higher highs, MACD making lower highs. So telling us that it's not really sustainable. We place our entry again, 5 cents below the low of this candle. Stop loss 5 cents above the high. We are far away from the 20 EMA, far from the 50 MA. We can hit our 2-hour target before hitting the 50 moving average that can act as a potential support. You can see there's a support here. So we hit our target price right before we hit our support and get out before the trend continues up. Okay. Next would be, oops, we already saw this, it's a duplicate. Next is COG. In price rises to a new high. Okay, bearish pin bar. We have got a higher high and a lower high. Right, so again, this should be a straight line, excuse my drawing. So we have got a bearish divergence. Let me attempt to draw that again. Master all my art talent. Ah, okay, missed it, should connect that, right? And like that. Great. So entry over there, stop loss over there. Okay, and we take the trade all the way down.